Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter like we normally do, see what people are sharing on social media. I'll interject my financial opinions as we go through it. Um, we've got a question and answer session going on today, 5 p.m. for those that are members of the website, just as a reminder. And generally, we talk about three different topics: wealth building, commodities, and/or financial topics. So let's dive in here. Let's see what people are talking about in social media. You can find me at finding_finance. If you want to join, add me. If you want to join our community, it's finding-value.com. We do have a discount going on. It's LEAP, LEAP, which is leap year. So it is leap year, and that's the discount code. So going in, Buffett going long oil indefinitely through ownership of Oxy Petroleum. Just like his Coke and Amex investments, Berkshire owns about 28% of Oxy plus warrants. This is what he said in his thing here. It says, "This year, I would like to describe two other investments that we expect to maintain indefinitely. Like Coke and Amex, these commitments are not huge relative to our resources. They are worthwhile, however, and we were able to increase both positions during 2023. So at year end, Berkshire owned about 28% of Occidental Petroleum's common shares and also owned the warrants that for more than 5 years give us the option to materially increase our ownership at a fixed price. Though we very much like our ownership as well as the option, Berkshire has no interest in purchasing or managing Occidental. We particularly like its vast oil and gas holdings in the United States, as well as its leadership in carbon capture initiatives, though the economic feasibility of this technique has not yet to be proven. Both of these activities are very much in the country's interest." So he's holding it indefinitely for Berkshire Hathaway owning Oxy Petroleum. Oil's making a big inverted head and shoulders, and nobody's paying attention to it these days. Up through 80 could get spicy pretty fast as CFTC longs capitulated eons ago, and there are probably some decent speculative shorts out there. There's your inverted head and shoulders. We go over this during the daily updates as well. I've pointed that out a few times. We're right at the neckline. We did get a little bit of a sell-off here recently, but we're right at that resistance level neckline, and when we break that, it's going to be a fun little ride to the upside, I think. Warren Buffett says, "I have every possession I want. I have a lot of friends who have a lot more possessions, but in some cases, I feel the possession possesses them rather than the other way around. I do feel like the more crap you own, the more you have to maintain those possessions as well, and it's almost like they have ownership over you sometimes. So that there is a lot of truth to that." Here's a scenario. You win $50 million tomorrow. You have 8 years to live after winning this amount of money. What do you do with it? And here's another thing that I kind of read this question, and the first thing that popped in my head is, what's more valuable, winning the $50 million or knowing that you have only 8 years left to live? I would say knowing that you have 8 years left to live is probably more valuable, and you're probably going to change the way that you live your life knowing that you only have 8 years left. And then the question is, what do you do with it? Is the question with how do you spend the money, or what do you do with the 8 years that you have left, or the combination of those two? I don't know if I would do all that much different. I would, yeah, I don't know. Good question. I don't know what I would do with it. I'm kind of already doing it to some extent with less money than 50 million. What sector are you the most bullish on right now? Well, I'm bullish on like 4 or 5 different sectors for very different reasons. I am getting very bullish on natural gas, but it's going to take some time to bottom out. But it is so cheap, and the situation is playing out where I think like 6 months from now, or maybe a year from now, or somewhere in between, those two time frames, we're going to bottom at some point, and then the equities are going to rip. They could go up before that because oil breaks that inverted head and shoulders. Then it could be even sooner for the equities of natural gas. So I'm very bullish right now on natural gas equities from here till probably 6 months to a year out as we go through the bottoming process. I think dry bulk shipping looks good. It's been ripping it. Looks very good. I think that platinum is very cheap and silver. They have very good ratios, platinum having the best. Those are also very good sectors that I am very bullish on. And depending on where interest rates go, could determine how much they go up. I think oil is very good. So oil, natural gas, dry bulk shipping, even the tankers look pretty good. So I would say all of those look really good. And I'm not most bullish on anything. That's just right now. Uranium might have a little bit of a pullback that we've got to go through. Yeah, so what? And then uh, precious metals, if we can get some footing here and we start to break some of this downside momentum and start heading back up, those could be some of my top sectors as well. The mining companies could do incredible things. So I'm going to go with oil at the moment, probably my most bullish sector at this exact moment. Oil and natural gas. Now, how do you become rich according to Mark Minervini? So this is what his opinion is on how to get rich. He says, go where the money is. I chose Wall Street because there's unlimited opportunity. If you develop great talent, the sky is the limit. If you're looking for a sunset, you must head west. He says, forget about money. Instead, focus on being the best. The best in any field gets paid very well. Invest in yourself and develop talent. Money is a natural byproduct of being great. First, you get the knowledge, then you get the experience, then you get the skill, then you get the money. Think in decades, not years. We tend to overestimate what we can do in 3 to 5 years and underestimate what we can do in 10 to 20 years. Wanting it too fast will make you quit early. Leverage yourself. You are the only, says you are only one person. How can you leverage your efforts? Social media is one way, a blog, a podcast, writing a book. Live modestly until you are at least a cash millionaire. I didn't even own a new car until I had $1 million cash in the bank. Until then, I worked and saved and kept my expenses very low. Follow my 10% rule. Only buy highly depreciable assets with no more than 10% of your net worth. This is a good rule to follow forever. Only lend what you are willing to give. This is especially important with friends and family. By adhering to this principle, if you don't get paid back, you don't sweat it, and you don't lose relationships over money. Never lay odd. With every business deal or investment, I always get odds on my money. Consider your savings at zero always. If and when some unforeseen event or emergency occurs, which it will, and you need to break into your savings, ask the following question. What would I do if I didn't have this money? Then do that. Never touch your savings. If you didn't have that money, would you find a way to survive? Yes, you would. So that is his rules of how to become rich by Mark, which I agree with a lot of them. True financial success is reaching the point where trading time for money is optional. I totally agree with that. Basically, I took my successes and bought my time. That's what I'm doing, buying my time. Here's Charlie Munger. He says, generally, I think it's quite smart to identify some investors you regard as very skilled. Carefully examine everything they're buying and copy what you please. That's pretty good advice. Here's Warren Buffett. He says, an investor needs to do very few things right as long as he avoids big mistakes. And another one from him, it's an easy game if you can control your emotions. And I would say most retail investors struggle with controlling their emotions. I would say their time frames are too short. They get too emotional and they sell out when they see a loss because they are frustrated with it. And they haven't wired their brain yet to buy when something's cheap and be patient enough. This is a game of patience, guys. And Warren said it before. It's money's just being transferred from the inpatient to the patient. I mean that's really what this game's all about. It really is. Here's another quote by Bill Miller. He says 100% of the information you have about any business reflects the past, and 100% of the value of that business depends on the future. Keep that in mind there, because what I'm doing is I'm trying to look out 5, 6, 7, 8, 9, 10 years and say what market conditions are going to come and who's going to benefit from those market conditions. I think, me personally, I think we're going to get into an energy squeeze. I think demand for energy is going to go up exponentially. And I think the supply side is going to be constrained. And I think that we're going to go through a very inflationary environment with with increasing interest rates. So then when you look out 5 years, 6 years, 7 years from now, who's going to benefit from that? And I struggle to come up with a bunch of different sectors. I think physical metals would benefit very much from that because there could be problems with currencies and bonds. I also think that energy investments are going to be massive. And I think that the pacing factor will be how fast we can grow energy supply. So, energy, in my opinion, is probably the theme of what I think will do well over the next 5 to 10 years and into the future if we don't solve it in that time frame. Oops. Coming down, JC says, does money now rotate back into technology stocks, or do the other sectors now follow technology stocks lower? So he's talking about technology versus the S&P 500 XLK divided by SPY. We've got the relative strength indicator rolling over and going lower. He's thinking that this might head lower, where technology is going to go down, and potentially the S&P 500 too. Generally, in that situation, technology stocks fall faster than the S&P 500, and that is what I think he's looking for. That's what I would be looking for too. I don't know if we've hit the exact top yet, but the rollover of the relative strength indicator and the squeezing up of this, you put another trend line up here, it's squeezing up into a corner, which will eventually break to the downside, most likely. Bubble trouble. So NVIDIA versus the semiconductor. I can't remember the name of SMCI, whatever it is. But he's got the Livermore accumulation cylinder here. Here is that Livermore accumulation cylinder, and then the big move up, point number 8 and potentially point 9, point 10. That's probably what I would say. SMCI has got a very similar accumulation cylinder going on in 2023, and then the big move higher. This here is wave 4. Whenever you get these sideways moves, they're generally wave 4s, where the pullback of wave 4 goes sideways, and then you get a blow off top. Sometimes they're extended like SMCI has. This generally will put in a topping pattern and probably work its way lower, would be my guess. I'm going to answer this question here. It was sent to me. He says, I remember a couple hundred episodes ago that you said you like to invest in companies that were most leveraged to the increase in its underlying commodity. Could you clarify a bit in the next episode? Do you mean companies with lots of leverage in form of debt? Like, would you prefer RIG instead of Valeris? Or is it more about being unhedged, like in natural gas companies? Or more ships on spot versus long contracts? Because I also remember that you say that most investors take too much risk versus reward. And this conflicts with leveraged to the upside. So let's answer that, and let me go into um, TradingView, and I can use that as a blank sheet to draw on. So I'm going to use this as a blank drawing sheet. Forget the DXY watermark in the middle. So what I mean by risk reward, I mean that if this is your potential return and the stock is trading here, This would be your risk, your downside risk, and you don't know this to be exact. But your downside risk and then your reward is, this is reward, is your upside potential here. This is your risk over your reward. What we look for is large asymmetric bets with tons of upside potential and then lower amounts of risk. The risk is basically two parts. It's sector risk, and then you've got the individual company's risk. So what I like to look for is I like to look for these gigantic asymmetric opportunities where you've got big upside potential and small downside risk, where they're bottoming. So I mean, I can go to an individual company here and give you an example. So I've talked about this before on the channel, SM Energy. So when I entered SM Energy, and I still own this, when I entered, let me go down back here. So SM Energy has it has debt, and what I saw was a couple of things that created this opportunity. One, I saw a squeezing of this pattern. Basically, we were squeezing into this corner here for SM Energy. We were squeezing on up. And I looked at the natural gas price in relationship to gold, the natural gas price in relationship to oil, and that was also very cheap. I also looked at the ratio of SM Energy in relationship to natural gas, and everything was coming towards this bottom here. So looking at the historical performance of the infrastructure that SM Energy has in place, the historical relationship was, this is my potential upside plus, and my downside when I bought it here is basically at the corner, and we were at the corner of the wedge, which I do this quite a bit. I buy in the corners or the right hand side of these wedges. That was the same situation that I had when looking at the ratio as well. It was a squeeze right into the corner here. So natural gas has fallen, yes, and we're getting a move up in the pricing of SM versus natural gas. You can see the outperformance. But I think natural gas at the current moment is completely mispriced. It is due to weather, and I think the opportunity is definitely in natural gas right now because it's so cheap. The reason SM Energy and a lot of these natural gas companies aren't falling down is because it's actually breaking to the upside. Because uh, I think people are positioning for what they know is in the future. More money printing. We're going to have a shortage of energy, in my opinion. I think natural gas, they're looking to really drastically increase natural gas prices. But I purchased it down here. I've been holding on the entire time. I did reduce a little bit of a position um, to diversify out just a teeny bit, but it's been going up, and I think this looks good to continue higher. And we're right underneath resistance. So if you're looking at, and I'm just going to use SM, if you're at this potential spot, let me back out just a little bit. If you're at this spot where you're in this corner here and you've got all of these things in alignment, cheap natural gas, cheap oil as well, then you've got the equity cheap to the underlying commodity, and it's squeezing up with technical patterns. In this corner here where I purchased it, why would I go with something that doesn't have as much leverage to the price move to the upside when you're this early? The leverage is, they could have debt that created this type of leverage. They could also be a higher cost producer or the combination of both. What I look for is I look for the infrastructure in place to generate the cash flow like SM has over here. They've come on back. They do have some debt. People got worried. They sold it off to pennies on the dollar. This was trading at $93. It went all the way to $1. So that was literally pennies on the dollar. It had the pattern. It's got the gigantic plus symmetry where it's got low downside risk, big upside potential. That's exactly what I look for. Now, if you're at the bottom of the market, why would you not take some of these bets? And the risk is risky because they could go bankrupt if the price doesn't respond. But my viewpoint was the market wasn't weak. they shut the market down, which caused this situation. And it was a great opportunity to buy a whole bunch of these companies because the market wasn't weak. The demand was still there. We were in an expansion phase of real estate, which is another thing that I look for in the real estate cycle. So I was looking at the bottom there for higher cost producers, which is leverage to the price of the commodity. The higher the cost producer, the more leverage you get to the upside. Then I looked at the potential infrastructure of what the company possesses and what potential cash flows they could generate in a higher cost environment of that commodity going up. And that's basically what I mean by leverage. It's the cost. And if the break-even point's high, it's going to sell off more in a bear market for the commodity itself. So if you're at the bottom of the bear market, I go after the most leveraged stuff because that's where the greatest asymmetry is in the market. And you won't be 100% right in all of your picks. So I spread it across, 5, 6, 7, 8 companies. I find them, and some of those have turned out incredibly well. They have literally added multiples on top of it and a zero at the end to my account in a lot of the companies that I chose at the bottom. And you can go back and look at the companies that I selected and posted on my YouTube channel to find them if you want to see them. This is one of them that I posted. I think I posted this one in November 1st or 2nd of 2020. It was right at the bottom there. And I bought it in September and October, or I think I bought it late September and October. I cost averaged in, and then I posted it, and I think I posted it in November. There were other companies too that I also posted on that have gone up over 10, 20x. I still own them in very big size. Now they're paying me dividends too to hold these companies, and I think they're going to accelerate to the upside. I think they're going to go. I think they've got a lot more upside potential still. And I've also positioned in a lot more companies. So leverage to the price move of the commodity. Debt can give you more leverage. That is what provides the buying opportunity at the bottom because debt is going to sell that company off more to the downside because people will be fearful of a potential default or bankruptcy on that debt. And that's what gives you the opportunity. So leverage to the commodity can be caused by a high debt load. And then when the commodity price comes back up, hopefully your company can survive. I thought that the companies that I went into, which did have a lot of debt, a couple of them had a lot of debt, which provided me the entry point of what I would consider to be a lifetime opportunity. We also had the crude oil to gold ratio above 50, and that was crazy, guys. We've never seen that in history. It's always kind of peaked out around 30-ish, low 30s or somewhere in there. Right now, we're at 26.8 is the 1 ounce of gold to 26.8 barrels of oil, which is still very cheap. So I think that these look absolutely fantastic in terms of the leverage that I get to the commodity price. And that generally comes from either having some debt and the high cost producer nature. The leverage is how much can you grow your earnings per share as a percentage of from where you're at. So if you've got a high cost producer versus a very low cost producer, a low cost producer going upward in the price does not give you as much leverage because the percent difference on their earnings per share to the bottom line doesn't change as much as a high cost producer that's not making anything at the current commodity price. Then the commodity doubles, then their earnings go up, quote, infinitely. They're dividing by zero if they're not making any money. So that's where you get the leverage. It's the high cost producers that provide the leverage to the price move. If you sprinkle in debt on top of it, then it becomes a very wild ride because they are highly leveraged and are dependent on the income from the commodity price going way up. And they'll get sold way off if the commodity price goes below their break-even point. And if it goes way below their break-even point, you could get into a situation where they go bankrupt. So the leverage is dependent on their break-even point and the debt that they have. And that is something that I do teach on the website as well. Exactly what I've described there. Then we go into a bunch of different companies of higher cost companies. We look at their presentations and go over all that stuff. And I like the ones that are give me the leverage to the commodity price. If I'm a bull on the commodity, I want that symmetry to be really out of whack in favor of a whole bunch of upside. And if I'm buying it at the right time, you're not going to have much downside risk. So that's what I like doing. And the bigger the upside, the less I have to put into it and the less I have to risk. And that's kind of really what leads to position sizing too. I mean, it is based off of where you're buying the asset and the risk reward symmetry that you have. That also determines a lot of where you should buy something or not buy something. But I'll go into deeper details of exactly what I'm talking about and give examples of potential sectors, companies, all of that with the question and answer session that I'm going to be releasing today, at 5 p.m. that we're having. So I'll talk about all this. I'll talk about why I'm choosing and selecting certain companies, why I bought and loaded into certain things. That's where the value's at. So I'll go into that deeper in the question and answer session, which I was going to anyway. And I'll talk about risk, portfolio position sizing, um, and dive into all that and how to use some of the tools that I have basically developed myself, I guess. I mean, if I think about it, I developed all those things of how to look at the markets to get what I consider to be risky sectors at very low risk times. So the risk, what people deem as risky is generally volatility or that big move to the upside. That's generally what a lot of people say is risky because they can't hold on. But if you can become seasoned enough and you kind of know enough to find really good entry points, that's what gives you the whole upside potential return. SM Energy is like playing NVIDIA on like times 10 because this thing goes up and down so dramatically in such short periods of time that, or crypto is the same way. A lot of the cryptos are like this as well. We get these gigantic upward moves very short periods of time. And that's why I prefer to do it because you don't have to put a ton of money into it. And if you get your timing right, you can make a lot of money in a pretty small period of time. So yeah, that's what I mean by leverage. It does deal with a little bit of debt. You don't want to have a company that's just way underwater of debt that they can't dig out of. You want some debt. You want fear in the market. Drive it down. Get it at a really good entry point, and then the commodity price comes back up. I mean, big move to the upside. And I do all of that screening for everyone who is a member on the website. I am actively finding companies that are higher cost producers. We have a whole bunch. We just bought a bunch of a couple companies that I've released, and there's some really good entry points too in other mining companies as well right now. So that are literally like they literally look exactly like this and are like right down here. That didn't work. They're right in the corner there. So, but it does require patience, and sometimes they don't go up immediately. Sometimes they might take 6 months going sideways. But that's all I've got, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Don't forget LEAP if you want to get a discount. A bigger discount on the yearly memberships. Smaller discount for just the first month if you're trying to sign up for the monthly. All right, guys. That's all I've got for today. We'll catch you later. This is Finding Value.